David, always good to have you join us.
Thanks, David, for having me.
You're welcome. Before we get to the quarter itself, I would like to, for a minute, divert to this deal with Toshiba. You're acquiring their global VRF and light commercial HVAC business. Why are you doing the deal, and how is it going to conceivably help you?
Oh, David, it's the perfect deal at the perfect time for us. The fastest growing segment in the global commercial HVAC market is this variable refrigerant flow, this VRF and international light commercial market. Toshiba has differentiated technology. They have a global brand that's respected. So for us, it adds a market that's growing at 2x the traditional chiller market. So it's high growth, highly differentiated, and it's only going to continue to outpace the rest of growth within the HVAC market. And it's also sustainable. We have a big focus on sustainability. And what you're dealing with VRF technology is it provides both cooling and heating, and the heating is provided through effectively an electric heat pump. So it's sustainable, high growth. It's the perfect time for us because, David, as you know, we spun from UTC less than 2 years ago with close to $10 billion of net debt. We now, through a whole bunch of actions that we've done, have less than $4 billion of net debt. So we're now playing offense on the capital allocation side. A great acquisition with the Toshiba business. We've announced a 25% dividend increase, a $1.6 billion share buyback. So we're in a position for really exciting capital deployment to create long-term shareholder value.
Yeah, well, on the subject of long-term shareholder value, I think you had operating margins up 80 basis points over 2020. This, despite obviously continued disruptions in the supply chain. So, what would they normalize to? And give us a sense, David, as what you are seeing when it comes to supply chain and the constraints that they may be bringing to your business.
Yeah, you look at last year dealing with about $450 million of inflationary pressures. We came into the year thinking it would be closer to 30. So clearly, and the good news is that we can pass that along in price. So we did see, significant price, significant inflation, but we still, as you mentioned, got 80 bips of margin expansion over 2020. And even next year, where we've talked about 5% inflation, 5% price realization, we're still looking at another 75 bips of margin expansion for 2022. So great work by the team. And it's through a combination of driving gross productivity, a few $100 million a year of gross productivity, and driving continued growth. Orders were very strong last year in fourth quarter, up 25%. We go into this year with record backlogs. So we're really poised for another strong year coming off 15% organic growth last year. We're looking at high single-digit growth this year, and it's because we're in the middle of these secular trends around sustainability, healthy buildings, cold chain. So we really like the position that we have right now.
So you don't think that those price hikes make you susceptible at all, or perhaps are going to be pushed a bit too far to actually dampen demand?
Not right now. I mean, we got to keep an eye on it, but right now we're at this peak inflationary point. So we've tried to take a very sober look and a realistic look at inflation. So we just came into this year assuming we're going to see $1 billion of inflation this year. We have to raise prices at least $1 billion, so we're price cost neutral. And this is that period of time where we really think you're at that max peak inflationary moment. So we do have to continue to drive rigorous cost reduction, control the controllables, raise price commensurate with inflation, and really make sure that we do everything we can to support our customers. And I will tell you that in many of our markets, we picked up significant share last year because we were able to support our customers operationally. We did have to pay a lot more on the input side for things like chips and some of the input costs, but we made a conscious decision. Let's keep operations moving. Let's keep the product flowing. Let's make sure we support our customers. And we did that at the expense of inflation, but we still saw significant growth and share gains.